Hey there, and welcome. Today, we're tackling a big one, financial trading. You hear about it all the time, right? Well, we're going to cut through all that noise and get straight to what it actually is, how it works, and maybe most importantly, the huge risks you absolutely need to understand. All right, let's get right into it. It's the oldest saying in the book, isn't it? Buy something cheap, sell it for more, and you've made a profit. Easy. But as you've probably guessed, when we're talking about the financial markets, that simple little phrase hides a whole world of complexities, strategy, and yeah, some pretty serious risk. So what's really going on here? So let's start at the very beginning. Forget all the complicated jargon you see in the movies. We're just going to build a clear, simple foundation. At its heart, that's all financial trading really is. See, unlike when you go shopping and buy something to, own and use, trading is all about speculating on which way the price is going to move. You're not buying a piece of Apple to hold on to for 30 years. You're essentially placing a bet on whether its price will go up or down, often in a really short amount of time. Okay, and this brings us to a really important point that trips up a lot of people. Trading and investing. They might sound similar, they both want to make a profit, but trust me, they are two totally different ways of thinking about the market. The real difference here really just comes down to one thing: ownership versus speculation. You see, investing is the long game. It's built on actually owning the asset. You buy the shares, you own a piece of the company, and you believe it's going to grow over years and years. You might even get paid dividends along the way. Trading, on the other hand, that's all not short-term speculation. You're not buying to own anything. You're just using these financial tools to bet on which way the price is going to swing, and you profit from that swing itself. So who's actually doing all this buying and selling? And where is all this happening? I mean, the scale of the financial markets is it's absolutely massive. Let's take a look at who the main players are. Now, while it feels like everyone and their dog is a trader these days, we call those folks retail traders. We're still a pretty small slice of the pie. The huge majority of trading, we're talking about 77% of it, is done by massive institutions. Think big banks, giant hedge funds. They're the ones moving enormous amounts of cash, and that, of course, has a huge effect on the market. And what are all these people trading? Well, just about everything you can imagine. You've got the Forex market, where global currencies are traded. You've got shares of individual companies, of course. Then there are indexes, which are like a whole basket of stocks, like the S&P 500. You can trade commodities like gold and oil, even things like bonds and cryptocurrencies. It's this huge interconnected world. All right, let's get into the nuts and bolts. How do prices actually move? And what are the key ideas that make trading work and also make it so risky? It really all boils down to the most basic rule in economics: supply and demand. This is the engine that drives every single price change. If some amazing news drops about a company and suddenly everyone wants to buy its stock, well, you've got way more buyers than sellers. Demand is high and the price shoots up. If the opposite happens, bad news hits, everyone rushes to sell, and the price tumbles. Every trader is just trying to guess which way that's going to go. And now we come to one of the most critical and dangerous concepts in trading: leverage. This is an incredibly powerful tool. It lets you control a really big financial position with just a small amount of your own money, called a margin. The key thing to understand, though, is that while leverage can multiply your profits, it multiplies your losses by the exact same amount. It is a classic double-edged sword. And that power of leverage brings us directly to this number. This statistic comes straight from the source material for this explainer. It's a risk warning they have to show you, and it is there for a very, very good reason. Because of leverage, the vast majority, 71%, of individual retail traders end up losing money. This is not a game. The risk is incredibly high, and it is very, very real. Okay, to make this all feel a bit more real, let's walk through a trade step by step. We'll use the numbers from our source and look at a trade on eBay shares using something called a CFD, or a contract for difference. Basically, with a CFD, you're just making a bet on the price change of an asset without ever actually owning it. You agree to exchange the difference in price from the moment you open the trade to the moment you close it. So, let's say you've got a good feeling about eBay. You think the stock's about to go up, so you go long, buying 150 share CFDs at a price of $51.63. And hey, you were right. The price starts to climb. You decide to cash out and close your position by selling at the new, higher price of $52.60. The difference there gives you a profit of $145.50 before any other fees.
Sounds pretty good, right? But hold on. We have to remember that every single trade is a two-sided coin. Your prediction could just as easily have been wrong.
So, what if after you bought in, eBay's share price fell instead? If you decided to cut your losses and closed your position at a new, lower price of $50.50, that exact same trade would have resulted in a loss of almost $170. And notice something here? The loss is actually bigger than the profit we saw a second ago. That's the reality of trading.
And that brings us to what is, without a doubt, the most important part of this whole explainer. If you only remember one thing from all of this, please let it be this next part. This is a direct quote from the trading provider. This isn't buried in the fine print. It's a headline warning. Instruments that use leverage, like CFDs, are not simple. They are complex, and the risk of losing your money, and losing it fast, is high. So let's just quickly recap. 1. Trading is short-term speculation. It is not long-term ownership. 2. Tools like leverage are a huge deal because they amplify everything, your potential gains and, just as easily, your losses. 3. The hard data shows that most individual traders lose money. And finally, you have to understand the very high risks before you even think about getting involved.
So there you have it. We've covered the what, the who, the how, and the big why you should be careful. We've seen how a simple idea like buy low, sell high explodes into this really complex activity with some major financial risks. So now the only question left is the one that only you can answer. Is this a risk you are truly prepared and, more importantly, can afford to take?